Kunal believes it's a good time to make a fresh entry into the stock given the kind of gap down that we're seeing on the stock right now, 5.5% of a slash over there. In fact, we have the management of SBI who's addressing the media. We'll cut right to it. Before that, I'm just going to take a look at some of the updated numbers that we're getting from SBI. Slippage at 0.54 for the year. And in terms of the amount that we were talking about earlier, it's 22,678 crore rupees of slippages in the year gone by. In fact, let's cut across and listen into the management themselves.
Deep appreciation, the continued trust placed in us by our customers, shareholders, partners, and the broader financial ecosystem. This trust is not just an enabler of performance, but also the foundation on which we build enduring value. Let me start with a brief description of the present global and domestic economic scenario. We are meeting at a time when the global economic narrative is being rewritten in real time. Global growth is projected at 3.1% in 2026 and 3.2% in 2027 by the IMF, reflecting a phase of moderation amid persistent geopolitical uncertainties and evolving trade dynamics. In contrast, India continues to stand out as the fastest growing major economy, with growth projected at around 6.9% for FY27 by the RBI. This resilience is being driven by strong domestic demand, improving investment activity, and policy stability. However, we remain mindful of emerging risks. Recent geopolitical developments and weather-related disruption, such as El Nino, may introduce some downside risks to growth. On inflation, CPI is expected at around 3.8% in April, with a full year projection of 4.6% for FY27. That said, global energy prices and climate-related factors may create some upward bias. From a banking system perspective, credit growth remained strong at 16.1% in FY26, while deposits grew at 13.6%. Encouragingly, this momentum continues into FY27, with credit growth at 15% as of mid-April, compared to 10.3% last year, and deposit growth standing at 12.2%, up from 10.2%. Looking ahead, we expect credit growth in the range of 13 to 14% and deposit growth at 11 to 12% for the whole system. Asset quality across the banking system remains robust and capital levels are comfortable, providing sufficient headroom to support future growth. Alongside these traditional indicators, two structural shifts are redefining the operating environment for banks. Recent developments in advanced AI models have highlighted the increasing sophistication and speed at which vulnerabilities can be identified and exploited. This has placed the Indian banking system on a heightened state of alert. The industry is working closely with the Government of India and the RBI towards a coordinated cyber resilience framework. Secondly, the RBI's guidelines and transition to expected credit loss-based provisioning from April 2027 mark a significant step towards strengthening balance sheet resilience. At SBI, we are well prepared for this transition. Against this backdrop, our strategic focus is to drive high-quality growth with simplicity and resilience at the core. We are consciously moving from a paradigm of scale-led expansion to one that emphasizes productivity, capital efficiency, and risk-adjusted returns. Every strategic initiative we have undertaken over the past year is anchored in this shift. We are deeply aligned with the vision of Viksit Bharat as we continue to see ourselves as a systemic enabler of India's growth story. Our long-term strategy is therefore designed to be both commercially sound and nationally relevant. A cornerstone of this transformation is Project Saral, which I mentioned earlier also, our operations process reengineering initiative, which is a structural reset. Having launched the first wave of identified themes, it challenges legacy constructs and reimagines the bank through the lens of simplicity and customer centricity. Key initiatives from the first wave include universal branch access, dismantling the traditional home branch mindset, single KYC across products, and automation of back office processes such as inward clearing using GenAI. Parallelly, we are investing deeply in becoming an AI-first organization. through our Analytics 2.0 initiative, we are embedding AI across the value chain, moving towards a truly data-driven operating model. In response to increasing financialization of savings, we are deepening customer engagement through YONO, ecosystem banking, and targeted offerings for diverse customer segments. We are also actively building relationships across startups, AIFs, VCs, and global trade ecosystems to diversify and future-proof our portfolio. As the largest bank in the country, our responsibility extends beyond performance to stability. Our centralized cyber cell operates 24/7 as a unified command center, reinforcing our commitment to secure and resilient banking, combining technology and human expertise to respond swiftly to cyber risk. Each of these initiatives is designed to deliver measurable gains in efficiency, stronger risk controls, and sustainable profitability. In the above backdrop, let me now give highlights of bank's performance in FY26. I'm glad to announce that we have posted highest ever net profit of 80,032 crores, an increase of 12.88% year-on-year in FY26. Operating profit for FY26 increased by 11.25% year-on-year to 1.23 trillion. ROA for FY26 is at 1.12%, an improvement of 2 basis points on year-on-year basis. Return on equity for FY26 remained robust at 18.57%, despite raising of 25,000 crores equity capital in July 25. Domestic NIM was at 3.03%, supporting our guidance to maintain NIM above 3%. I'm happy to share that our total business has crossed 109 trillion rupees, reflecting customers' continued trust in us. In fact, our domestic business has grown by more than 11 trillion on year-on-year basis. Our balance sheet size has crossed 76 trillion rupees. Bank's total deposits have grown by 6 trillion rupees at 11.03% year-on-year to 59.76 trillion rupees. Retail term deposits have grown by a robust 14.77%. Savings account deposits have witnessed a growth of 10.6% year-on-year, and CASA deposits have grown by 9.53% year-on-year, with the CASA ratio at 39.46%. We've been able to improve our CASA ratio by 33 basis points on quarter-on-quarter basis. The deposits growth remained healthy, with growth in double digits, despite competitive market environment. Deposit our foreign offices have grown at 12.7% on year-on-year basis, but in USD terms it is 2%. Credit growth has been robust, and all segments have registered double-digit growth. In FY26 and on year-on-year basis, domestic advances grew by 16.33%, driven by all segments, SME by 21%, agriculture by 20%, retail personal advances by 15.22%, and corporate advances by almost 15%. Retail, agriculture, MSME, popularly known as RAM portfolio, has crossed 27 trillion rupees with year-on-year growth of 17.11%. Our foreign offices have continued to perform well with growth in advances at 20% year-on-year. In USD terms, it is 8%. The domestic credit deposit ratio was 73.08% at the end of FY26, an improvement of 337 basis points year-on-year. The bank has enough headroom to address future credit growth requirements. Our asset quality continues to be healthy. Our gross NPA ratio has improved by 33 basis points year-on-year and stands at 1.49% as at March 26, and continues to be at its lowest level in over 2 decades, which demonstrate the quality of our loan portfolio, proactive management, structural integrity, robust underwriting capability, and sustained recoveries. Our net NPA ratio has also improved by 8 basis points and stands at 0.39%. The consistently improving asset quality is also reflected in our credit cost, which is at 0.37%. The NPA book is well provided with PCR at 74.36%. The bank remains well capitalized, and we have sufficient headroom to take care of business growth requirements. Our capital adequacy ratio has improved by 115 basis points year-on-year and stands at 15.4%. CET1 ratio has also improved by 148 basis points to 12.29%, and both the ratios are well above regulatory requirements. Digital adoption is central to our vision, enabling a multi-pronged transformation focused on enhancing customer experience while optimizing costs. By shifting 98.7% of transactions to alternate channels, we are scaling both efficiency and growth. The successful rollout of the new YONO platform has become a massive acquisition engine with over 4 crore users in just 3 months' time. Now, YONO has more than 10 crore registered users. 66% of new saving accounts originating on YONO platform in FY26 demonstrate our successful transition to a digital-first institution. We are effectively meeting the evolving needs of new generation and a diverse nationwide customer base through our formidable physical and digital channels. Our subsidiaries continue to perform strongly and remain leaders in their respective segments. They are important drivers of value creation, and we will continue to nurture them. If I were to summarize our approach, we are building a bank that is simpler in processes, smarter in decisions, stronger in balance sheet, and sharper in customer focus. We are proactively strengthening our CASA base and empowering our workforce to lead in a transforming financial landscape. We are actively reshaping our balance sheet by enhancing digital capabilities, broadening funding resources, and leveraging YONO for customer acquisition. SBI, by virtue of its scale, has always been a reflection of the Indian economy, and we aspire to not just remain a participant, but have become a key enabler of that journey. To conclude, I would like to thank all of you once again for your continued engagement and support. We remain committed to delivering sustainable, responsible, and long-term value. As India advances towards its aspirations of becoming Viksit Bharat, we take pride in playing our part in that transformation. Thank you for being with us today. My team and I will now be happy to take your questions. From the presentation, we have grown across the segments. RAM, corporate advances in double digit. We are continuously seeing that credit growth in the current quarter also, which gives us confidence that 13 to 15% credit growth is eminently possible.
So my second question is on your net interest margins. They've seen a sharp dip, and I guess that's the reason why stock has taken a hit to today. Wanted to understand if you could just explain the dip in the number, and can we safely now say that the worst for margins is now over, the bottom is now here?
I think in the last quarter, in Q3 also, we did mention that a couple of rate cuts which have happened in December, middle of December, have not been fully taken in the EBLR book. So that is 25 basis point cut in December, and also we had a 5 basis point MCLR cut. That's one main reason where EBLR book got repriced. The second thing is, there's been a substantial growth in the EBLR book itself. If you have seen both home loans and MSME, which are essentially linked to the EBLR, that also has contributed to the NII reduction. While we have been very successfully containing the cost of resources. In fact, the cost of resources has come down over the last quarter. And the NIM guidance, what we have given, exit NIM of 3%, I think we were able to fulfill that. And we have given this guidance that the NIM will be, exit NIM will be 3%, and that has been achieved. This year, we still continue to provide the guidance of NIM of above 3%.
For next question, Zoel Rebello from Economic Times, please.
Good afternoon, sir. Sir, other income has fallen quite sharply. I'm assuming that's because of Treasury.
Yeah.
Mostly, I have not seen the presentation very closely, but can you give us some details on what Treasury income? And also on the Forex side, we had some regulations from the RBI in March. So how did you all manage to, tide over that?
I'll answer the second question first.
And then Treasury also.
Treasury. On the NDF-related guidelines, we were able to unwind the portfolio of $5 billion what we had with a minimal loss. The loss on account of unwinding was 57 crores only. So that has not contributed to any major forex income losses. But we did have valuation of derivatives and swaps, what we normally do for proprietary requirements. That has resulted in forex losses. So the overall treasury losses consists of your bond yield movement, which has sharply moved in the last quarter. That is about 1,800 crores. And then we have on the equity side about 2,000 crores. And on the forex derivative side, around 50. Overall, the treasury losses were about 4,500 crores. Sorry?
That's why other income is.
Other income is there. Otherwise, if you see the other sources of, other sources of non-interest income, every segment has gone up. I think you can pull up this slide on fee income. Both on the ACA recoveries, fee-based income, loan processing charges, every segment of other income have shown a significant growth over the last year and even over the last quarter too. Yes.
Sir, no, because you all are expecting a good growth. I mean, still, because despite the challenges on inflation and like you mentioned, West Asia and all that, you all will need funds, capital. I know that there's a board meeting set. If you could just throw some light on how you all are going to plan for the year ahead.
So on the equity capital side, if you see our CRAR is about above 15% now. So this CRAR will give a headroom of almost 12 trillion rupees to be supported. I think on the capital side, there is no requirement of any additional capital to be raised. And a significant profit accruals are also there. And with a change in the guidelines where you can book quarterly profits and which get added to the capital structure, that provides a continuous basis for us to grow the book. I think on the capital side, there is absolutely no concern. And we don't intend to have any new equity capital raise anytime soon.
Hamsini from Manipur, please.
Hi, sir. Good afternoon. So just one clarification before I ask my question. This 13 to 15% credit growth that you have factored in for, does it also include the ECLGS drawdown that will happen, etc., which is giving you the comfort to maintain that kind of a guidance? Because most of the banks, even the large private sector, they've either refrained from giving any guidance or they've reduced their guidance. So just want to understand.
So ECLGS, though there is a potential of 70 to 80,000 crores, what I mentioned yesterday, my belief is that not full amount will be utilized. This is an opt-in kind of thing. We're not saying that people are, eagerly looking forward to this facility, but it's a very proactive measure what government has taken. So it is available. The facility is available, and from SBI assessment, almost 70 to 80,000 crores worth loans can be taken. My assumption is that 30 to 40% people probably would avail in the best case scenario. We assume that the conflict will not linger for long, and the demand for ECLGS probably would be lower than what we anticipate. By this 2.55 crores, what Government of India assessment is outer limit, and our own 70-80 crore limit is also outer limit. So we have not based our 13 to 15% growth rate on the ECLGS at all. We think that is a natural progression, and even if assuming that in some sectors we are unable to grow, probably this ECLGS will contribute to achieve this 13 to 15% growth rate.
Okay, that's the SBI management, and we will keep cutting across to that management chat. Just looking at the market texture, and we're closing in the week with that 178-point downtick on the Nifty as we speak right now. We've been flagging off that today, single-handedly, names like SBI, HDFC Bank, Axis, they've been the drag points for the Nifty. In fact, you could add to that even an ICICI Bank or an L&T also for that matter. But look at names like a Titan. That spiked up about 6.5%, even though the numbers fell short of market expectations. Asian Paints has seen a 2.5% uptake. Apollo Hospitals has been a very strong show from the word go today. And then in bits and starts, you're seeing some of the IT names as well hold out, and HCL Technologies, TechM, Infosys are shades of green. Reliance, a little bit split and divided, marginally higher as we speak right now. And I marginally say marginally only in context with what names like a Titan or Apollo Hospitals, for instance, are up to. But I think the one standout factor, and Kunal, correct me if I'm wrong here, through this week has been the broader market outperformance and the fact that, the midcap 100 index managed to hit that record high for itself. And you're mesmerized seeing moves on an NBCC, on a Coforge, or Novama, which is up over 10% right now.
Yeah, Isha, and in fact,